Hey, hey, Rosie. How you doing, Rosario?
Very well. And you, Professor?
I'm good. I'm good. How's everything?
Good. Can't complain.
Okay, good. Hello. Um, I wanted to make an announcement. I wanted everybody to be aware that the only thing that we do on Blackboard or through Blackboard are the lectures. Everything else is done through MyLab. So make sure that you get on this platform. You have a 14-day trial, and once you have the trial, once it's over, uh, and when you join again, it will automatically pick up from where you left off. So keep that in mind, right? Everything is done. That's the only way I can grade you. Nothing is done through Blackboard. Everything is done. The only thing that we do through Blackboard are the lectures, the homework, the quiz, the final, the midterm, or everything is done through Pearson. Okay, so let's start with where we left off. We wanna go over the homework, and this is pretty straightforward. It's chapter 1. Everybody did well. Um, and can everybody see this? The homework and the quiz are pretty similar. This is saying that the advantages, there's no limit to the number of, okay, first thing first, if you see a question like this on your, you know what? If you see a question like this on your midterm, okay, and you see it says choices, that means that there are more than one answer. Don't answer all of them because you'll get them all wrong, right? Pick out the correct ones. And then here you have disadvantages, also said choices. If it says choice, it's one. Choices mean two. Okay? So there's no limit to the amount of owners. The life of the business can continue if somebody dies. The liability of owners is limited to the amount of their investment. Income to a C corporation double taxation, right? Once we receive owners form of a dividend. C corporation is more complicated and more expensive to set up than any other business entities. That's a fact, right? To get a corporation, oh my God, right? The profit of S corporation are passed directly to shareholders and not subject to corporate tax, while C corporation must pay taxes on any profits before passing. Yeah, Ethan.
Yeah, So the first line was explaining, well, at least for the S corporation part, was talking about like the pass-through entity thing, about the
Right.
single, right? So can you give me like a definition for pass-through entity again? Because I took business law too, but I wanted to
The what?
like a definition on like the pass-through entity definition.
Pass through entity?
Yeah.
Um, Talk to me after class. Let me continue. All right, I'll get to
No,
that.
for sure. Don't worry.
Okay. Okay. So here we have where we have a C corporation and there's double taxation. Now the way you do that is you say 1 minus the percentage, and then you know how much is being charged, and then you do the same thing for the 25%, 1 minus 0.25 on the second part. So it looks something like this. In S corporation, you only pay personal tax. Now, I said this before, the financial manager, the most important type of decision the financial manager makes is the investment decision. Why do shareholders agree on the same goals for financial managers? All decisions by the financial manager are made with the context of the overriding goal of financial management to maximize the wealth of the owners of the stockholders, right? And the stockholders have invested in corporation, putting their money at risk to become the owners of corporation. This is called like an agency issue. The agency problem leads an individual, in your case, in corporate managers, in corporate, to put their self-interest ahead of the interests of the shareholders, right? In both situations, there may be a lack of interest in controlling costs if those costs are not both directly by the person making the decision. So what does that mean? That means that a lot of times, right, when it's not your money, you really don't care. You really don't care, right? Now, one of the best advice I can give anyone who's going to be working for a firm or a business, you want to make your managers really happy. Act as if the money that you're working with or the customers that you're dealing with or whatever, it's like your business. It's like your money. Once you take those type of initiatives, right, you'll go very far in a company. Okay? This is what this is saying, right? It's not yours. You say, I don't care. It doesn't work like that when you work for a company, right? Every little bit counts. And if your manager takes notice to that, he or she would definitely know that you are a caring person about what you do. One of the things that used to happen in the old days that I explained before where CEOs used to get into deals that they know that weren't making any money. They know that it was a doomed for failure within a year or so. So what they do now is that they tie the CEO's salary to shares of the company, and he cannot redeem those shares till 5 years later. So what happens is if whatever he got into or whatever deals that he made, if it was a disaster, he will suffer just as much as the shareholders, if not more. And when you first, on an IPO, right, when shares are first issued, they're issued on the primary market. And then the next day, when they continue trading, they sold in the secondary market. When you're at an auction, the guy who is selling the item is the auctioneer, and he's asking, and the people that are buying are bidding on it. And that's it. And then the difference between the bid price and the asking price is what the broker makes in the transaction. Now, I believe that the homework and the quiz were very similar. Were almost identical. Everyone did really well. This is our first homework assignment. And just make sure that you keep doing your homework, because at the end of the semester, okay, you're welcome, Alexis. At the end of the semester, right, I don't have anything for extra credit. Your extra credit is your homework and the quiz. That's your extra credit. That's 30%, 15 and 15. So I advise that you pay a lot of attention to that and make sure that you do them. Okay. We're going to move on to chapter 2. Hold on, let me bring that up. All right, can everybody see this? Hello?
Yes,
Yes,
Professor.
Professor.
Okay. What we're going to be discussing are financial statements, understanding the function. We're basically going to focus on the balance sheet. You know, we're going to talk a little bit about income statement, interpreting cash flows and all that. And we'll get a little bit into stockholders, equity and all that. But basically, we're going to be talking about what a balance sheet is. One of the key questions one of the things that they ask is, does anybody know what an auditor is? Anybody know what an auditor is? Go ahead.
Auditor is a person who reviews the financial statements of a company and analyze
Reviews what?
review and analyze the accuracy of the financial statements.
That's right. That's right. And not only financial statement, but anything, an auditor's job, right? Before we start, an auditor's job is to make sure that the firm is in compliance with what it says it does, and it really performed those tasks. So for instance, if Queens College has an audit, right, they wanted to make sure that professors were actually online when they say they were, right? They will go back and check Blackboard to see if indeed he was signed on at that time. for all those hours. If they were to like go back and check the hourly, how they got paid. If they wanted to check if anyone was, for instance, a restaurant, right? In the old days, you didn't have a count. You just went in and you made an order, right? And you really didn't have a flow of knowing how much you spent on eggs, how much you did with that. Now in today's, right, we know that it's done through a computer, and it's very hard for the cook to take stuff at home, right? For instance, if you own a pizzeria and someone is stealing $40 a day from you, in 10 years, they stole they probably steal like $100,000 at $40 a day. So how did I come to that number? We say 200 times 40 times 5, right? It's that 5 days a week he works. That's 200 a week, right? And then times 50, that's 10,000 times 10 is 100 grand, right? And we used to catch, when I worked at Citibank, through audit, we used to catch people stealing all the time, right? And in the banking system, right, you had to be out for at least 2 weeks. 2 weeks. Email wasn't a big thing back then, right? But you had no access to your email nor your phone. And the way audit saw it, if there were any discrepancies in the work that you were doing in that 2 weeks, in those 2 weeks, it should show up, right? So we've caught many people. We used to catch many people, not me per se, but the bank used to catch them all the time when they used to go on vacation and somebody else was doing the job. And then boom, something came up and then it unraveled, because numbers never lie. 1 and 1 is 2, whether we're here or in space. So that's what an auditor does. An auditor does, as the person, I forget who it was, definitely reviews and makes sure that you're in compliance. There are signatures on everything. What they say is true, and go on and on to check, making sure, right? Because people cook books. People cook books all the time, right? Balance sheets get cooked up and all of that. That's why I always tell people to start off with as a analyst when they work, because they see all that, right? Whatever you do, numbers don't lie. If you say you have this much in inventory, we have to see where it's coming from, where it's going, and how it's done. If you say you paid out this amount, we need to see the canceled checks. Now, here's one for you. If Madoff, if they would have had an auditor go over their books, they would have caught them on the same day. The same day, he would have been busted. If they had an audit, a real audit, meaning somebody says, okay, Mr. Madoff, can you tell me where you put this investment, where it is? And they did do something really fishy. I know someone that family in Great Neck, they told them that they put their money into they bought a treasury bill. So they called, he said, can we have the CUSIP number? CUSIP number is an assigned number for a treasury bill. And they called DTC to see if indeed they bought a treasury bill under his name. And they found out that they didn't. That's all they had to do with any of his investments, so-called investments, instead of just moving money around. Tell us where the money is. What did you buy with it? And that's it. And just follow a trail. All right. Now, there are different types of financial statements, right? You have the balance sheet, you have the income statement, you have the statement cash flow, and the statement of stock equity, right? We're going to be dealing mostly with the balance sheet, right? With the balance sheet. And what the balance sheet does, it gives you a snapshot right? The balance sheets gives you a snapshot of the firm, right? It tells you right then and there of their final position, right? And what it is, it tells you exactly where the firm stands, right? So there's a big difference between a balance sheet, book value, which is what the balance sheet is, and market value. We're going to get into that in a few minutes, right? Big difference, major difference. So the assets list the firm's cash, inventory, property, plant and equipment, and any of investment the company has made, right? When you say asset, you mean things that you own, right? Things that you own, the assets, right? They're on the left side. And the liabilities, which that you're liable for, right? That shows the firm's obligation to its creditors, right? In other words, if I work at Citibank and we bought we bought some bonds and we have not paid them, right? The firm, we're liable. The firm is waiting on this money, so that's a liability to its creditors, right? So keep in mind that one is where you owe and the other one is where you owned. That's the difference. Then you have stock equity, also called shareholders, right? Which is the difference between what you own and what you owe. That's all it is, right? At the end, when we look at the book value between how much we have and how much we owe, and the rest goes into what the shareholders get. And it has to prove out. Prove out meaning it has to balance. Our assets have to equal our liability, right? If I have $200 in assets and I owe $100, 100 that balance of $100 would be considered what is for the shareholders, right? That's what's for the shareholders. And then we would prove that we put that 100 there, and that would make it balance. That would make it balance, right? So it'll look something like this. We have current asset, cash, of course, one of the biggest assets you can have, because that's great, because that's money. Receivables, right? If someone buys something from us and they're due to pay us back, right? We're waiting for that money to come in. That's considered money to be received, accounts to be received. That's what that means. Accounts to be received. And usually, when I worked at Citi, we didn't like receivables to go over 30 days, right? Because it didn't look bad. It made us look bad. And it also didn't look good for our area that we had a receivable running that long. And when we did, senior management usually got involved with the other firm to get the money in so we can resolve the receivable, meaning making it flat. So this can increase in value, and also we have more money down here. Now, inventories is what we own, right? Let's say we were a sneaker company. Our inventory would be our sneakers. If we sold jewelry, our inventories would be jewelry. Whatever it is that we did, that would be our inventory, what we own, what we have on hand. That's what that is. Then you have long-term assets, right? We might own property, we might own plant, we might own equipment, All these things are part of our long-term asset, meaning things that we've had for a while, right? We've had for a while, right? And we own, right? Those account for our assets. Now let's look at the liability. Accounts payable now is when we owe money going out, right? We have to pay our creditors. So that's account to be paid, right? Short-term debt. A lot of companies borrow when they need to pay out something, right? So you can have short-term debt, meaning not less than a year, we'll pay it back. That happens, right? We needed to get something and we did not want to use our cash because something might happen. So we decided we were going to borrow. Then that's the total current liability. Anything past that, long-term debt, right? That's like debt that's more than a year old. That's like going out. We might borrow money for 3 years, 4 years, 5 years, whatever it is. It's longer than a year. That's considered long-term. At the end, right, whatever's left over, right, it goes into the common stock, return earnings, right? Earnings that we retain to reinvest. A lot of times what companies do, if we were, let's say after we were done, right, at the end, we say, okay, we're not going to send out a dividend check. What we're going to do, we're going to reinvest the money and we're going to buy new machines so that we can increase production, thereby increasing more profit for next year. So a lot of times people are all right with that. I know I would be if I was investing in a company, a small company, and I wanted the money to grow because you got to hold your position in order to make sure that your money will grow in value. So the balance sheet's identity is assets equals liability plus stockholders' equity, which I explained here in the beginning, what I told you with the 200 and 100, right? Assets are divided into current and long-term, as we discussed, and current assets are either cash or assets that be converted into cash within 1 year, right? Marketable securities, even the account receivable can be sold to another company. We're not going to get into that. Anyone who's taking accounting knows you can do that, right? Companies do that when they're in the bind, right? I'm due to receive. Here's a perfect example. If you go to the dentist and he fixes your teeth and you owe the dentist $600 and you have not paid the dentist, right? He's waiting for that account receivable. So he's waited 3 months, you haven't paid him. He sells it to a company and instead of 600, he got 400 for it. Now the company comes after you so you can make this payment. Okay? So receivables can be sold. So that's a receivable. That's what I mean by selling them, right? The doctor or the dentist wants to get something out of it. So that's why he decided to sell his receivables, right? Inventories compose of raw materials, I said, finished goods, right? Sneakers, jewelry, diamonds, whatever it is that you're selling, right? And you have them on inventory, you have them there. Other current assets include prepaid expenses, rent, insurance, all these things, right? Now, long-term assets is something that it's long-term, past a year, 2 years, right? One of the things that we're going to be discussing is when you buy a piece of equipment, and it depreciates, right? Where we're going to be using a negative number to show our depreciation in our calculations. right? So let's say, for instance, you bought a a tractor and you're a farmer and you paid $1 million for the tractor, and your tax rate on the tractor is 30%. So that means that you can depreciate $700,000 in 5 years of that depreciation. You can take it in 1 year or you can do it in 5. So each year you would add that to your numbers, right? So as a write-off, right, to lower your taxes, you would write a negative depreciation to lower your taxes, right? And then add it back in because it's not a real expense. Remember this because we're going to be touching that further down into the class. And when we get to at, net present values and stuff like that, right? The book value. The book value is what you depreciate, right? It's like a car. You buy a car for $10,000, right? You can't, if you were to like deduct taxes from it, you can't deduct the whole 10,000. You have to deduct what the book value is, what the car is worth, right? That's what they mean by that, what the book value is. So we talked about accounts payable, the amount you owe to suppliers for products and service, right? Short-term debt, loans that can be repaid in the next year. I explained that. You have accrued items, you have salaries, revenues that has been received for product, service that have not been delivered. Those are things that you're waiting on. So a thing that we talk about is net working capital, where current asset minus current liabilities. When your current net working capital has gone down, meaning you have more money to spend. Your liabilities are, I'm sorry, your assets are more than your liabilities, right? Your net working capital has gone down. If it has gone up, meaning you have less money to use, right? And then you have long-term debt, more than a year. I explained that. Yes.
If the net working capital has like gotten larger, doesn't that mean that you have more current assets? So,
The other way around.
but if it's current assets minus current liabilities,
No, hold on, Michelle. What did I say? No, if your net working capital goes down, you have more money. If it goes up, you have less. Because I'll show you that in the formula in a little while. Okay?
Okay.
All right. All right. So, and then we're talking about book value of equity, right? There's a difference, big difference between market value and book value. What do I mean by that? Right? When take a firm like Amazon, take a firm like Amazon. If we were to look at their balance sheet, right, we will look at their receivables, the buildings that they own, and whatever else that shows up on the balance sheet. It will be maybe $2 or $3 billion, maybe even more. Their market value, what they're worth on Wall Street, is almost $1 trillion. Okay? So there's a big difference between book value of equity, and market value. Right? Another example, if Boeing right now if Boeing sign a deal that they're going to be building 700 planes next year, right? Next year. That would not show up on the balance sheet until next year. However, Wall Street, the market value based on this future deal will raise the market value of Boeing on Wall Street. Got it? Right? That will raise their market value on Wall Street. The book value wouldn't show that until the deal is done. However, Wall Street will somehow put Boeing's shares as high as going up, right? That's how it works. So one of the things that always to remember is market value versus book value. So the way you calculate the market value is the number of shares times the share amount. The number of shares times the share amount. And that's how you calculate the market value of a company. Now, you take a company, yes,
Is it the number issued or outstanding?
the number of shares outstanding, outstanding, issue same, right? Times the number of shares times the number of shares outstanding, right? If Amazon has 1 million shares outstanding and is being sold at $10 or $100, you say 100 times 1 million, whatever it is, that's their market value. Okay? So when you're doing market to book ratio, when you're comparing your market value to your book value, right? A company that's really healthy, it's usually 2 to 3 times the amount. The market value is about 2 or 3 times more than the book value. Now, if you take Amazon, forget it. If you take Apple, on another level, Google on another level, right? When you're comparing. However, we're going to see that some companies, like the companies I used to work for, their market value is very, very, very low because of certain things that happen to them. Right? So I gave you guys I gave you a formula sheet. I gave you a formula sheet. And the formula sheet is on Blackboard, and you're going to need it because of what we're going to be doing on chapter 2. Right? And what it's going to be doing, it's going to make comparisons, right? Ratios. And when you compare the ratios, when you're comparing ratios, and it tells you the health of the company. Sometimes when a company has too much outstanding debt, it depends. Sometimes that's not a good thing. That's not a good thing. If I'm going to invest in a company that I know that has a lot of debt, right? When you're an analyst and you're checking on these things, sometimes it's not a good thing. It's not a good thing. So when I worked at Citibank, one of the things that got to Citi was the fact that they were holding toxic commercial real estate. They had toxic commercial real estate. And when it was reported on the news, I knew someone that was working there and they're about to retire. The stock was at $55, if I'm not mistaken, at the time. And they had almost $2 million worth of Citibank stock. They were about to retire. By the time it was said and done, he had $40,000. The stock had gone to single digits. The stock did so poorly that Citibank was removed. It was part of the Dow Jones, was removed from the Dow Jones because it was messing up the average because it was so low. They have what they call a reverse split, meaning they gave you less shares for what you had. So if you had 10, they gave you 5. That's what a reverse split means. So what happened was, if you look at it, this is what it is. This is saying market to book ratio. And Citibank was at half. It was at 0.57. It was a horrible thing. Amazon must be past this, right? It must be all the way up to the ceiling over here now. It's worth way over 25 times their book value. Way over that. Way, way, way over that. So is Google, so is Apple, all those, right? I'm talking about their balance sheet versus their market value. That's what I'm talking about. Now, when you want to sell a company, and you need to know exactly what your firm is worth, it's the market value plus debt that's on the balance sheet minus the cash. That's the enterprise value. If we need to know exactly what the company is worth, and let's say they want to buy it, whatever it is, the enterprise value, here's the formula right here, right? Market value of equity plus debt minus cash, right? That's what the enterprise value is. That's also on your formula sheet. One of the problems that happens a lot of times, right? You want to pay off your debt, right, with the cash that you have. You want to pay them off. Right? If you're buying a company, and first thing you want to do, anybody would tell you, is we need to get rid of creditors. We don't want creditors calling us. Just like when somebody owes money to a credit card company and they have people calling them all the time, same thing. Same thing. Same thing. Right? No difference. Same thing. Yes.
In the market value, in the book value of equity, isn't retained earnings and the market prices of the stock also there? So like, what's the difference between the book value of equity?
Well, when they paying it out, yes, when they paying it out. But in this situation, what I'm talking about, good question, Soel. In this situation, what I'm talking about is that when we're comparing the market value, your shares, you're right. You're absolutely right when you break it down in the balance sheet. However, I'm talking about the market value. the market value of the company, right? The market value of the company. That's what I'm talking about. But you're absolutely right in what you just said. Hold on, let me just go back. So the depreciation that we're going to talk about in when we get to the homework is going to be how you calculate depreciation, right? You can either take it in one shot in 1 year, or you can break it down. Most companies like to break it down, right? In sequence, right? They like to break it down. They take it in 5 years. One of the things that people always have a problem with is understanding that it's not a real expense. It's to bring down your taxes. Because once you depreciate, let's say 1.2 million, whatever it is, you have to add it back in. And I'm going to show you that. In this situation, the depreciation is 1.2, a negative, right? And so if you look at here, earnings before taxes is 10.4, which is right here. You add back the depreciation because it's not a real expense. It's something that to bring down your taxes. It's not a real expense. So if I wanted my customers to see my bottom line, I want them to see this 11.6. I want them to invest in my company, not this 10.4. I want them to see that this is what I'm really worth at the end, not this, right? This right here brings down my taxes, right? Brings it down because I'm adding that, I'm deducting that. So my taxes are lower. However, when I'm done, I add it back in. And we're going to do that towards the end of the semester, right? We're going to do that at the end of the semester. So when we look at this whole thing, right, and we talk about different things, net income, bottom line class, when you work for a company, there's no breaking even. You can go into a company. Some guys like to get a foothold in there. Like I said, Amazon knows that they see how Costco's doing. They see how all these other places are doing. So they got their foothold in the food business, right? They just send it because they can afford to do it. They have money. They have money to splurge a little bit. So they get into things. But bottom line, when you work for a company, you're there to make the company money. Period. Period. That's what they want you there for, to generate profit. They want you there as an asset, not a liability. Okay? Always remember that. Right? When you go work somewhere, they want you there as an asset. Where even if you're in an area where you're an expense, but your expenses are minimized. If you work in operations, it's not like you're on a trading floor where your income, you're making money for the bank. But yet, you're not losing money also when you're an expense because you're not making mistakes. You're doing the right amount of rounding. You're going after your receivables. You're making phone calls. You're making sure that all deals are settled the right way. You're following ordered procedures so we don't lose money. You're rounding the right numbers when you make a deal. When you're trading currencies, you're making sure that you're on the right side of the currency and you make the deal as soon as possible because you see how fast currencies change. And I know some of you said, well, it's only $10,000 and we make billions, but $110,000 adds up. You make 100, if everybody thought the way you did and 100 mistakes are made in one day in that one area, we're losing money left and right. So that's what you have to think about when you work for a company. That's what it's all about. Period. All right. Now, when we talk about operating activity, right, I just want to touch on that. Those are like expenses that incur to run a business, right? All these things that happen while you're running a business. Okay, let me see something. There's one more thing. You know, if you, one of the things that I always tell my students, if you go on the internet and you look at Amazon's balance sheet, and after that, you look at their market value, it's beyond belief. You just wouldn't believe it. And getting back to reporting practices, I just want to make one point about auditing. In the old days, auditing was done with pulling out envelopes and checking papers and all that. Now it's more streamlined, right? They do it streamlined. What do I mean by that? It's done on a PC, and all you do, what they do is they compare what you say based on what's outstanding, right? If you said that the company that your company owns this and that, they want to prove that. A lot of times, like Enron and those guys, they carry two books. There was a company in Long Island. What they were doing is that they were double counting, and they got caught. I forget it was the name. It's a mortgage company. The guy just died. One of those guys died, and what it was is that when it was a mortgage company, when somebody refinanced a loan, you're supposed to take the old loan off the books and put the new one on. They were keeping the old loan and the new loan to make their balance sheet seem hefty, like healthy or beefy, as we say. And through audit, they got caught. They got caught through an audit. They were caught. So that's why, and I don't think they ever recovered from that. That's why. Huh? Hello? What'd you say? So somebody said something? Okay. All right. Now, let me. Okay, you guys there?
Yes.
Yes. Yes.
Yeah.
All right. So I'm looking at the homework. Okay. Okay. And I'm gonna go over a couple of the questions, and then I'm gonna let you guys drive. But before I do that, before I let you go, I want to make sure you understand.
Sorry, Professor. Can you show me that table again, please?
I will. I
Because I
will.
just
One
want to
second.
take.
Hold on. Hold on. I'm going to say something, right? So it says right here, what was the change in Global's book value equity between 2015 and 2016, right? So the change was between 22.1 and 20.3, which equals 1.8. Okay? You look for total equity, which is what the global book value of equity is, and the difference between those two is 1.8. Got it?
Yes.
Okay. Now, these other questions, right? I advise an increase of book value doesn't necessarily increase in Global's share price, right? It says, does this imply that the market price of Global shares increased in 2016? Explain your choices, right? So you would pick these three based on what we've talked about. Read the chapter again and what we talked about, go over it again, and you will be able to answer the bottom questions here. But if you look at this, take a picture, you might be doing good, right? These numbers are going to change. This number right here might change, but this right here you might see it in a different way. Now, let's look at another one. Okay. This is what I wanted to talk about. Here, this question, right? It says, suppose a firm tax rate is 35%. What effect would a 10.32 million operating expense have on this year's earnings? What effect would it have on next year's earnings? Now we're talking about depreciation, okay? So the way you're going to do this, is you're going to say 1 minus 0.35, which converting this into a decimal, 1 minus 0.35, which is 0.65, times 10.32. And because it's a depreciation, you're going to put a negative number here. This is one of the few times that we're going to be using a negative number because we only use absolute numbers. So if you take out your calculator, now keep in mind that when you do this homework, these numbers change. That's what makes MyLab a little different than a lot of the other platforms. The numbers change. So take out your calculator. 1 minus 0.35 is 0.65. 0.65 times 10.32 is what? Tell me, I can't see that.
Negative
What's that?
6.71.
6.71?
Yeah, negative though, right?
That's right. Good. Now, if you take your depreciation in 1 year, in the first year, it will have no effect. It will have zero effect. There will be no effect on next year's earnings because you've taken it all up front. Do you understand that? You're not going out 5 years, you're not going out 3 years. You took it all in one shot. So there will be no effect on next year's earnings. Right? Now, it says, what effect would a 9.2 million capital expense have on this year's earning if the capital is depreciated at a rate of 1.84 for 5 years? So it's already broken down for you, the 1.84. The 1.84 is already broken down. This, if you divide this by 5, you're going to get 1.84. If you divide this by 5, you're going to get 1.84. So we're going to say 1.84 times 1 minus 0.35 equals what? And it's also a negative number. Come on, class, help me out.
1.20.
Wait,
Is that what it is, or do I put a negative, or what?
Negative 1.
Negative? Good. That's how you do this, okay? Now, what happens is on MyLab, these numbers change. These numbers change. So each time you do it, let me finish. Each time you do it, you should know the concept behind this. Since it's a depreciation, it's a negative number. Yes, Salel? So
Professor,
you have your hand up?
can you please explain again the B, question B? Thank
Yes, this one right here.
you. Yeah.
When you could take depreciation in 1 year, or you could break it down into 5 years, right? So here it's being broken down into 5 years, right? So each year we'll be able to depreciate 1.84 at a tax rate of 0.35. Keep in mind, that the government is not stupid. They're not going to let you deduct the whole amount of what you paid. They figured that the book value of what you have is minus 35%. So it's 0.1 minus 0.35 is 0.65. 0.65 times 1.84 is 1.20. Do you understand that, Soel?
Yes, Professor. Thank you so much.
Okay. That's what it is, right? You're taking your expenses and you're spreading them out. Some companies do it 3 years, but here we're going to be doing it for 5 in our class here. Yes.
So we deduct the 35% times the depreciation expense?
No, it's not 35%. 35%, yes, you deduct 35%, but to do it right, it's like you're going into a store to buy an item that's $10 and it's 35% off. If I want to know how much I'm going to pay for it, I say 65%, I'm going to be paying 65% of it. If I want to know the amount of the deduction, I'm going to say 35%, right? Here, I want to know how much I'm going to be paying. How much I'm going to be paying. So how much I'm going to be deducting. So I have to say 100, which equals 1 when you do it as a decimal, minus 0.35, right, which is my tax rate, leaves me with 0.65. I want to know what this number is. If you do it the way you're saying it, you have to do it twice. First, I'm going to say 0.35 minus times this, then subtract it from this, right? I have to do it twice. I have to figure out the decimal, the amount of 35%, then subtract it. But if I do it the way I'm saying it, all I have to do is say 1 minus 0.35. This is 0.65 times this one time, and then I come out with this number. This avoids the double, right? First figuring out how much to deduct, then subtracting it, and then put the answer. But the way I'm showing you, you do it all in one shot. Got it?
Yes.
Yeah.
Okay. So this question right here, remember this question because you're going to see this question again. Hint, hint, hint. Okay? And I am going to tell you something. Some of you are saying, oh, this is so easy, this, that, this, that. Believe me, when you are taking the exam and the pressure is on, you're going to make mistakes. And you know the word, the blank happens, you ain't seen nothing yet. It's easy because I'm driving with you. Right? It's easier because I'm driving with you. But once I let you drive and I'm out of the car, the pressure is on. All right? So keep that in mind. Keep that in mind. And this problem is always has a negative number for this problem. I can't stress this enough. And you're going to forget it as we move on
Why is it negative again?
because it's depreciation. Remember we talked about that in the lecture? That depreciation is always what?
Negative. It goes down.
Right. We said that.
So its earnings would be higher each year by negative? Why is it lower there?
Oh, no, Michelle. Michelle, let's say this was deducted from the balance sheet, right? On the in the statement we were making to send out to decrease our, hold on, let me finish, to decrease our earnings, right? Because what this would do, if we add this in to the sheet, the income statement, right? What it would do, it will bring down our taxes because we have so much expenses, right? The more expenses you have, the less taxes you pay. You know that, right?
Yeah.
Hello? Right? But this is not a real expense. This is something that they let you charge to bring down your taxes. So at the end, when I'm done with the balance, when I'm done with the income statement, I add it back in, right? Because what it does is it lowers my numbers. It lowers my numbers because I'm deducting it. It lowers my earnings. But at the end, I add this back on again. As I showed you before in the lecture, right? I showed you that 1.2 was added on to the 10.4, which made it 11.6.
So if we're adding it, then why is it negative? I know depreciation is negative, but if they want to know the earnings before all
No,
these things.
no, listen to me. Listen to me. Listen to me. You buy a tractor. Listen, okay. You buy a tractor. Okay, you buy a tractor for 10.32 million, right? And we have a company. We're allowed to depreciate that tractor. But the government is not stupid. They're not going to allow you to depreciate the whole thing. They have a tax rate you can deduct, right? So it's 35%, right? So we want to know how much this is, right? 35% of this, what we can charge. So we're going to say 1 minus 0.35, which is 0.65 times 10.32. When we're doing our books, our income, we can depreciate the tractor on our numbers to bring down our taxes. But it will also bring down our earnings because it's a negative number that we're adding into our sheet, right? To bring down our taxes. But at the end, when we want to show our earnings for the company, we add back this deduction to the amount. Let's say, for instance, when we did the balance, when we did the income statement, it was $10 million that we had. We're going to add this 6.71 at the end because this is not a real cash expense. We've already spent the money. This is not a, this is just to bring down our taxes. Got it?
Yeah, I got it.
Okay. Now, anyone who's ever been in my class, I have what they call a, well, time is running out. I have what they call a give me question, meaning something very simple that everybody should get the 3 points or whatever it is on the exam. Okay? This is going to be your give me question. Okay? So let me show it to you. This is a very, very simple question, right? You know what? Let me take, I'll come back to this because I have to explain it. Give me 1 second. Let me take attendance. One thing I have to explain to all of you is that these things take time to explain, and we're going to get through this. We will, believe me. Believe me, we'll get through this. And stop me if you don't understand something like you're doing now, because that way we'll be able to solve things, the problems, because the same way that you see it on there is the same way it's going to appear on the exam. All right, and we will continue on Thursday, and because we're going to need a little more time, and we'll pick up on that third question, and we'll do the homework, and we'll go over the quiz, some of the stuff that you don't know. What it is that the numbers change, so you need to know the concept behind these problems. Okay, so I'll see you guys on Thursday. Have a great night.
Bye, Professor. Thank you.
Is homework 2 going to be up today or on Thursday?
We didn't go over it. We didn't go over it. We have to go over it. I just can't give it out like that. Okay?
Thank you.
Thank you, Professor. Have a good night.
Take care.
Professor, I have a question.
Okay.
Yeah, I just need your advice. Like, you go through chapter 2, the balance sheet part and some of the important stuff. So, can I just focus on those things, or shall I go through the whole chapter because that's a long chapter?
No, just go over what we've done on the homework. What I just showed you, go back and look at it. Just bullet points.
Okay, because yeah, just like I need your guidance because this chapter seems too much, but you cover like.
No, we're going to stick to. Let's just stick to whatever. Okay.
All right. Thank you, Professor.
All right.